Welcome to Explain the Charts, where today we are conducting an in-depth analysis of GBPUSD on March 23, 2026. The market is currently navigating a complex web of central bank policies and geopolitical instability that has kept the British pound and US dollar in a state of high volatility. Recent news indicates that the Bank of England has surprised markets with a hawkish hold, signaling a readiness to act against potential inflation spikes. Meanwhile, the Federal Reserve has kept its rates steady between 3.5% and 3.75%, suggesting that rate cuts are not coming as soon as previously hoped. Adding to the mix, conflict in the Middle East has sent energy prices soaring, creating a risk-averse environment that often favors the US dollar as a safe haven. On the daily chart, we can see how these fundamental drivers have translated into a series of significant price swings over the last several months. Looking back at late 2024 and throughout 2025, the pair established a long-term upward trajectory starting from the 1.22 level. By mid-2025, the pair was consistently trading above 1.35 as the UK economy showed signs of resilience against global headwinds. However, as we entered early 2026, the bulls met stiff resistance near the 1.38 level, leading to the current correction phase we are analyzing today. The daily candles show a clear struggle to maintain momentum above 1.36, which has now become a major resistance zone. Conversely, we have seen strong buying interest emerging whenever the price dips toward the 1.32 to 1.33 area. This indicates a massive tug-of-war between BoE hawkishness and USD resilience, fueled by higher oil prices and geopolitical fear. Traders should note the transaction volume remains high, suggesting that institutions are actively repositioning their portfolios for the next quarter. Currently, the daily timeframe suggests we are in a broad consolidation range while the market waits for more definitive economic data. We are closely watching for a breakout above the recent highs or a breakdown below the psychological support at 1.33. Zooming into the price action from the start of 2026, we can see the formation of a local peak at 1.3825 on January 27th. Following that peak, the price action became increasingly bearish as the Federal Reserve's hawkish tone began to outweigh the Bank of England's optimism. Notice the candle on January 30th, where GBPUSD dropped nearly 1% in a single session, testing the 1.367 support level. Throughout February 2026, the pair attempted several recoveries, but each high was lower than the previous one, forming a descending channel. By late February, the price was struggling to stay above 1.35, eventually sliding toward the 1.34 handle as we entered March. The daily candle on March 13th was particularly telling, as it showed a 0.97% decline, pushing the price down to 1.322. This sharp drop likely reflected the market's reaction to the escalation of conflict in the Middle East and the surge in oil prices mentioned in recent headlines. However, look at the bounce that followed on March 16th and 17th, where the pair reclaimed the 1.33 level with significant volume. This recovery aligns with the news of the Bank of England's hawkish tilt, which provided a much-needed floor for the sterling. On March 19th, we saw a massive bullish candle where GBPUSD climbed 1.2%, reaching a high of 1.346. This move was a direct reaction to the BoE interest rate decision, where traders priced in higher-for-longer rates in the UK. But the gains were quickly trimmed on March 20th, as the resilient US dollar and safe haven flows pushed the price back toward 1.333. The daily chart now shows a long upper wick on the March 19th candle, which is often a signal of supply-side pressure at higher levels. This 1.345 to 1.350 zone is now a critical area for bulls to reclaim if they want to target the early 2026 highs again. For now, the daily trend remains neutral to slightly bearish as we continue to trade within this corrective structure. Short-term support is very clearly defined at 1.322, which was the low of the recent flush. A daily close below 1.322 would open the doors for a much deeper correction toward the psychological level of 1.30. On the other hand, if we can sustain a close above 1.345, it would signal that the bulls are ready to challenge the primary downtrend line. The VWP for recent daily sessions is hovering around 1.333, indicating that this is the fair value price the market is currently revolving around. Watch for the next daily candles close relative to this VWP level to gauge the immediate directional bias. Let's drop down to the 1-hour chart to see how the market behaved during the first week of March. Between March 2nd and March 5th, we saw a clear consolidation period where the price was trapped between 1.328 and 1.342. On March 2nd at 11 o'clock Universal Time Coordinated, the price reached a local high of 1.3412 before starting a slow grind lower. This hourly data shows that every time the price approached 1.34, sellers stepped in to protect the level. By March 3rd at 10 o'clock Universal Time Coordinated, the price had fallen to 1.328, which provided a temporary bottom for the intraday traders. This type of range-bound behavior is typical before major central bank announcements or geopolitical shifts. We can see a series of small, indecisive candles throughout March 4th, where the volume was relatively low compared to the sessions before. Notice the attempt to break out on March 5th at 9 o'clock Universal Time Coordinated, where the price spiked to 1.3376, but failed to hold. This failure to maintain higher prices during the hourly sessions was an early warning sign of the broader daily sell-off that occurred later in the month. The hourly VWAP throughout this period was remarkably flat, showing a lack of conviction from the major market participants. Support at 1.330 held firm on several occasions, creating a horizontal base that traders were watching closely. Resistance at 1.338 also proved difficult to penetrate, with multiple hourly wicks rejecting that specific price level. When analyzing the 1-hour time frame, look for these tight consolidation zones as they often lead to explosive breakouts. In this case, the eventual breakout was to the downside as the US dollar gained momentum on the back of rising inflation concerns. Understanding these micro-ranges helps in identifying the points where short-term momentum shifts. Now we turn our attention to the 15-minute chart to analyze the high-frequency movements between March 18th and March 22nd. This time frame gives us a front-row seat to the volatility surrounding the Bank of England's announcement on March 19th. Prior to the announcement, on March 18th, the pair was drifting lower, finding support at 1.325 during the late session. At 13:42 Universal Time Coordinated on March 19th, we see a massive surge in buying activity, with the price jumping from 1.330 to 1.335 in just 15 minutes. The momentum continued as the pair pushed toward a peak of 1.346 during the afternoon sessions. However, as we moved into the evening of March 19th, the rally began to stall as profit-taking hit the market. By the morning of March 20th, the price had already retraced significantly, falling back into the 1.33 range. Observe the candle at 9:57 Universal Time Coordinated on March 20th, where the price dropped to 1.336, marking a local reversal point. The 15-minute chart shows that the 1.340 level acted as a magnet, with the price oscillating around it before ultimately falling below. Support was eventually found near 1.329 during the late Friday session, as traders closed out their positions for the weekend. On Sunday, March 22nd, the market opened with a slight gap, but price action remained subdued as it consolidated near 1.333. This timeframe reveals how quickly the news-driven gains can be erased if the broader trend does not support the move. The transaction counts during the BoE spike were nearly 5 times higher than the average, showing intense institutional participation. For day traders, the 15-minute support at 1.330 and resistance at 1.346 are the primary boundaries for the current week. If the price fails to hold 1.330 on this time frame, the bearish bias will likely intensify. Conversely, a breakout back above 1.340 could signal another attempt to test the recent highs. The VWAP on the 15-minute chart for the most recent sessions is sitting right at 1.332, which acts as the current pivot point. Always pay attention to how the price reacts to the VWP on these lower timeframes to identify trend reversals. The RSI on the 15-minute chart was extremely overbought during the BoE spike, which correctly predicted the subsequent pullback. Currently, we are seeing a series of higher lows on the 15-minute chart since the Friday bottom, which is a mildly bullish sign. As we recap the daily chart and the overall market structure, let's summarize the key price levels for GBPUSD. On the upside, the primary resistance is the 1.345 to 1.350 zone, followed by the major psychological barrier at 1.36. On the downside, the most critical support level is 1.322, with a deeper secondary support at 1.300. The short-term outlook remains neutral as the pair consolidates between the BoE hawkishness and the Fed's resilient stance. I believe there is a 60% likelihood that the pair continues to range between 1.325 and 1.345 over the next 2 weeks. This scenario is reinforced by the current lack of a clear catalyst to break the stalemate between the two central banks. There is a 25% probability of a bearish breakdown below 1.322 if geopolitical tensions in the Middle East worsen and drive more safe haven flows into the USD. A 15% probability exists for a bullish breakout above 1.350, which would require a significant weakening of U.S. economic data or a further hawkish shift from the BoE. Traders should keep a close eye on upcoming U.S. inflation data and any updates regarding global oil supplies. The correlation between energy prices and the U.S. dollar is currently very high, so a dip in oil could provide a boost to the pound. In the long term, the bullish structure from 2025 is still technically intact, but it is being severely tested by the current macro environment. Wait for a daily candle to close outside of the 1.322 to 1.345 range before committing to a larger directional trade. For short-term trades, look for reversals at the 15-minute support and resistance levels we discussed. Always use proper risk management, especially during times of high geopolitical uncertainty and central bank intervention. Monitor the daily VWP at 1.333 as it will likely serve as the balance point for the coming sessions. If we see a strong volume-backed move away from 1.333, that will be our signal that a new trend is forming. We will continue to track these developments here on Explain the Charts to keep you ahead of the market moves. Thank you for watching our in-depth analysis of GBPUSD for March 23, 2026. Please remember that this video is for informational and educational purposes only and does not constitute financial advice. Always perform your own due diligence and consult with a professional advisor before making any investment decisions.